We are live with Adam Niman.
Niman.
Messed that one everyone tells me I mess up last names. It's like this thing I do. Niman. Adam, tell us, how did you get here? Explain this to us. Who are you? What are you about? What are we about to talk about today?
So I'm really basic financial services guy, selling life insurance. I started out in the industry.
You're a basic financial services
guy?
guy?
I call it basic. I want to keep things simple. I've made money being too complicated, and I've lost a lot of money making things too complicated. I'm just trying to kind of settle into what I know, and that happens as you get older and you're in and around business for an extended period of time. But I, after university, I lived out west for a year, didn't know what I wanted to do with my life. Skied in Whistler for a year, taught skiing out there, was great. Came home, didn't know what I wanted to do, had my resume online, and I got contacted by a life insurance company. And the advantage with them is that they provided leads through a union network, and it was captive, and they gave you 20 or 30 leads a week. And as long as you would drive to, outside areas of the province, you would get more leads. It was hard to get leads in Toronto.
I love this talk of leads. This is classic sales.
Yeah, and the goal was 4 to 5 appointments a night. You booked your appointments on Sundays and in the mornings. But it was multi-level marketing style. So the idea was you needed to build a team. That's really how you grew. You could only make so much selling your own product. You got to scale yourself. And how do you scale yourself? Well, you go online and you hire people to sell for you, and you train them. In my office early on, there was a gentleman that was being paid to teach the life insurance course. So I went to the guy who headed up the office and I said, listen, I will teach the course. I passed it pretty quickly. It's not that hard. But like anything, you just need to study and know how to pass the test. And I said, I'll teach the course for you, but code me people out of the group immediately. So I was able to build a team pretty quickly. But it's hard. You got to stay on script. You need people who either don't have kids in the house or who don't have kids at all yet. So it's the young and the old. And people didn't stick. It was really hard to build a team. And it was kind of a war of attrition. So if you could stick around long enough, build a good enough team, you could grow. But you're only selling one product. You're kind of drinking the Kool-Aid, because that's how MLM works. But it was incredible sales experience. I knew that.
You learned a ton.
Yeah, totally. More about myself and more about, my ability to commit to something when it's hard. Like, man, you're going into houses randomly, 4 to 6 people a night, Tottenham, Schaumburg, Alliston, 10 years ago. I would go up to, I went up to Sudbury. Like, I had people not pull a gun on me, but I would bring up, it was funeral plan insurance. And I remember I had one guy, I brought up death, and he basically went to the back, and the wife said he's getting his rifle. And I was like, I'm fucking leaving. Like, it was really intense.
Why was he getting his rifle?
Because he was very religious, and talking about death just did not work.
Oh, so he wanted you out?
Yeah, he wanted me out of the house. Yeah.
And he wasn't going to use his words?
No, he was, he was I got him through the hunters and anglers. So it was like a hunting group as well, that we got the leads through, So it was just a crazy experience, but.
Good for you, man. This is what it takes. You need to learn. You need to handle these situations. It makes you stronger. You learn about yourself.
Totally.
Awesome.
But they're also...
Hold on. Did he come back with the gun before you left, or you left before he got back?
No. I think he came back in, and the wife was like, oh, he's getting his rifle. I think she was just fucking with me, to be honest with you. But knowing that I came there through the hunter and anglers,
You weren't going to try to call the bluff.
Right? No, exactly. But there were a lot of times that, listen, you're talking about things that are uncomfortable.
Sure.
And the nice part about that gig was getting comfortable being uncomfortable, which is like a massive part of sales, as you know.
Of life.
Yeah, totally. There was another situation, this kind of forced me to kind of get out of it. I remember it was my last appointment of the night. It was in Tottenham, Ontario. I was training a guy, and I remember I get to the door. I can't remember what union he was with. I knock on the door, said I'm here through this company, and he opens the door. He says, I'm not letting you in unless you have a shot of whiskey with me right now at the door. And I'm like, sure, right? Whatever. Have a shot of whiskey with him. Sit down at the table.
How did you know it wasn't poison?
That's a good question.
Fingers crossed.
I never actually thought of that, right?
Crossed.
I remember I get to the table. I'm with a guy. I'm training him. So we were driving around all night together. And I get to the table and he says the same thing. you're not starting your pitch unless you have another shot with me. And I said, listen, fine, but only one more. Because like I was still had to drive home.
Sure,
right?
yeah.
And I go through, it was all scripted. And the nice part about this job was that it taught you how to stay on script, right? Which is important in your early years in sales to an extent, you know? And I was able to close him on a small whole life insurance policy, good normal commission. After I closed the deal, I'm like, by the way, what about something for your wife? And he says, actually, my wife can't get insurance because I can't remember what she had, but she had some sort of illness or issue that she couldn't get insurance. And I said, listen, if your wife can't get insurance, you should insure your kids under the policy for, 15, 20 grand each. It'll cost you an extra $5 or $6 a month. Not because they need the insurance, but what if in 10 or 15 years they have the same thing? They can't get insurance. At least they can get something then. And he's like, that's actually a good idea. Add $5 or $10 a month. And that was actually my first claim. About 8 months later, sadly, the kid was riding his bike past the main street in Tottenham behind his buddy, 8 years old. His kid went across the street and he was just fired. And that was sadly my first claim. And it was brutal. But they kind of thanked me for, the policy and whatnot. And,
that's giving me chills.
It was a crazy situation, and I was already kind of felt like I had, 1 foot out the door at the company, not because I had a problem with the product or the people. It was all great, but at some point in time, you just feel like you're ready to move on from something.
Yeah, the next challenge.
And that kind of, I really wanted to sell like actual products. With this company, you're captive, so you could only sell what they were selling. And objections that I would get on the road a lot was, listen, this is great, but we have this and it's cheaper. And you always had to find a way to get around the objection. So the way we would do that is, let's say someone had, $500,000 of insurance, and I'm offering them a funeral plan and another 100,000 of insurance. I wouldn't say, well, this is another 100,000. I'd say this is 2,000 a week for the next 50 weeks, and it would be more significant. So it was all about handling objections, overcoming the objections. ABCs always be closing. And at some point in time, I'm not good at drinking the Kool-Aid. I could do it for a little bit, but at some point in time, once I get the full scope of a product or a business, I need it to be real and I need to move on. So after this experience, I was lucky enough to meet a gentleman who had a large book of business, both insurance and investments. I met him through my mother, and he basically said, listen, I can't do this forever, and maybe one day you can take over my book, but you got to last. So he gave me a desk in his office, and I started from scratch. How old were you? Oh, that was 2012. I'm 30, so 26, 27 years old.
Okay.
And it was hard starting from nothing, But early on, through my brokerage, there was a gentleman who had a small book of business, and he was leaving the industry. He wanted to move back to the UK or something. And he had about 200, 250 clients, all small insurance policies. But I saw this as, 250 warm leads. I work with 250 cold leads. Yeah, this is awesome, right? So I bought his book of business for like $25,000.
Wow.
And there were small trails there that allowed me actually to move out and like rent a place, which was nice. But more importantly, I had a stack of 250 people. So I basically...
You already had customers.
Yeah, it was great. I had 200. I remember I printed it all off. I dealt with it like I dealt with the leads on paper. I did my calling sessions, and I basically had a well of people and 250 people that would take you to do meetings, especially back then, pre-pandemic, everything is kitchen table in the evenings and weekends, right? So that was basically a sweet. This is basically 2 years of work right here.
Where does this drive, sorry to interrupt, where does this drive come from? You seem very driven, very, you have an ability to just kind of put your head down and get things done where no one's going to do that.
Ooh, that's deep. I don't know. Insecurity, not being good enough, like wanting to succeed, seeing my dad work extremely hard. Dentist, put a lot of time in and effort in. And the way I saw it is, it's great, but you got to be able to scale yourself, and it's easier to scale yourself in financial services. Like, it's nice to make one sale and not have to put effort in to continue to get paid you know? That's the nice part about insurance and financial services. You get that trail, right? It's small, but if you can commit to it for 10, 20 years, policies turn over every 10 or 20 years. You're basically guaranteeing an annuity. You're guaranteeing being busy.
It builds,
you know?
yeah.
It builds. The nicest part about my industry, I'm sure you guys can say the same for yours, is you meet people who do everything. Everyone needs to buy a house. It doesn't matter what you do. Everyone needs to buy insurance. Doesn't matter what you do. And you know, going to school.
Do we though? Do we really? That's I feel like you can't phase Adam.
Fine.
I just
When I
phased
say
him
sorry.
again. When I said, did you see a look on his face?
Rent one, at least. Like, you know
Okay,
what I mean, right? Or like everyone needs to deal with the roof over their head.
Yeah, absolutely, absolutely.
And like, there's just so many jobs out there, people that you meet. That's how I got. It works out. Sometimes it doesn't, but.
So this gets you going then in insurance. You're on your way.
Yeah.
And then do you start selling some of these insurance products that we want to pick your brain about today?
Of course, yeah.
So how does this evolve? You start selling these products, and how do you get to the point to writing this book, Fortune or Fiction?
So,
is there a subtitle to the book? Why the be your own banker concept is flawed.
Yeah.
Like how can you just transition us now from starting this to get to writing this book?
So I wasn't really, at the end of the day, when you're getting trained in the industry, they train you on all the products, whether it's term or permanent. And permanent insurance is a very popular product, obviously, specifically whole life, participating whole life investment grade insurance. And through my book of business that I bought and one other and a few others that I have, there's a lot of people who have these policies on the books. And they get dividends and the policies grow and they pay out. They're like secure, good products. But I did notice with a lot of the clients that at least I dealt with, and maybe my opinion is skewed because of what I've seen out there, right? I don't deal with the wealth stuff. I'm hoping to more as I grow, and I am, just like you want to deal with bigger clients as you grow. But early on, I dealt with, the crap, the shit. And I noticed that a lot of these products,
the shit clients,
The shit clients.
not the shit clients, but
shit
like,
product.
listen, if you rent your house and you can't afford, if you hardly afford rent, you're not putting a lot of money into investment grade whole life insurance, right? But I noticed that a policy that was supposed to be worth in the hundreds of thousands of dollars after 20 or 30 years was a fraction of that. And
so that's the value of the policy that people are hoping they get if they were to actually.
Yeah, so they were showed this thing in the 1980s and early 90s.
Yeah, what's the thing called when you're buying that policy? It's like it's a projection, but there's like a name for it.
Illustration. Yeah, totally.
Right, it's that table that you
a nice chart.
Yeah,
usually has graphs that go up to the right.
Yeah.
Why wouldn't it always go up to the right?
Of
Listen,
course.
all investments go up to the right if you zoom out long enough.
Yeah.
So, but none of them were what people thought they would be. However,
sorry, what do you mean by that? None of them.
You thought it was going to be worth $400,000 at this age, and it's only worth $150,000 at this age, right? Why? Why is it worth a fraction of what I was promised? Well, interest rates were high then; they're low now, and
so walk us through why that. So they were high then; they're low now. So what? You're not earning enough to compound into.
I don't know. I honestly don't know. But the idea is that when interest rates were high, all these are heavily based on interest rates, as I understand them. And because interest rates were so high, insurance companies love guaranteed investments, projected these sorts of returns.
If we're earning 8, even 10%, compound that forward,
there you go.
Here are the results.
Look what interest rates were in the 80s, right? Nonetheless, they're not that way. They basically were continuing to drop slowly, 2 steps forward, 2 steps back, 1 step forward, well into 2008 and beyond. And thus, because interest rates went down and they're very interest sensitive, the dividends aren't what you thought that they would be. But nonetheless, these people didn't look at these products like an investment. It was still life insurance. And if something happened to them, the money would be paid to their family. And the reality is they weren't paying a lot per month, maybe 20, 30, 40 bucks a month. It was still security. You're in your 70s and 80s. It doesn't make sense to cancel it. It's still inexpensive. So you don't think anything of it. Maybe that causes you to not necessarily push your kids to do it because, it was a scam, but you know what? It was cheap and thankfully I have it. And that's kind of what led me down this path. I specifically met someone in the context of these books of businesses through a referral. Sold her, I go through this in the book. I sold her a term policy and she had an old participating insurance policy from one of these companies. And I'm an advisor. I took it over. Her advisor was long gone at that point.
Hold on to, you speak with your hands like I do.
Sorry.
Hold on to the table, hold on to the table like that. Just because we're picking up a little bit.
Yeah,
of bang
sorry.
on the, no, you're good. You're good. This is great. You keep going.
So I became the agent of record on her policy, not thinking anything of it. And I noticed in the first year that it was copied on her annual statement that she didn't get a dividend at all, like zero. Her policy was purchased in 1979. It was, I think, a $50,000 policy. And it was worth $80 now, so it grew by $30,000 through about $10,000 or $12,000 in paid-up additions. So over the last 20 or 30 years, she received $10,000 to $12,000 in dividends, and those purchased an additional $30,000 in life insurance for her.
Okay.
So $80,000 policy. But I noticed that she wasn't getting dividends, and this is something I hadn't seen yet. I'd seen people with reduced dividends, but I hadn't seen people with zero dividends. So
you got to help me out here. So the policy wasn't earning any dividends.
Yeah, based on our...
And the way it was advertised is the dividends would be earned and reinvested.
Yeah, totally. And they were for the majority of the life of the policy, they were, but just for the last few years, there was nothing, you know? So I emailed the insurance company, say, well, what's going on here? And they're saying, well, interest rates were high then, they're really low now. The block that she's in is not profitable, so we're not issuing a dividend.
The block.
Yeah, that was in your book. That was quite interesting.
Right.
So
whenever you buy these policies, they block people, they group people and policies with similar characteristics. You know, so you guys, I don't know how old you guys are, but
50, 40. Oh, you're not 45 yet.
Oh, 44, spring chicken.
Oh.
I don't know. So maybe you would be in a similar block, but 38-year-old guy, I'd be in a block with other people 38 years old. I really don't know enough about the intricacies and the actuary and the nuance behind how these blocks are created. But the way I understand it is similar characteristics are blocked together. And your block needs to be profitable to be issued a dividend. And that's separate from how the fund is doing. The fund, the participating fund, which operates like a pension, can be profitable, and it is. You know, these funds, some of them have been around for over 100 years. Consistent positive annual returns.
That's how they're sold.
That's how they're sold. But that doesn't necessarily mean your piece of the pie is profitable. And the reason why is because when you buy your policy, the illustration that you see is based on a certain set of assumptions. Those assumptions are very interest rate, as I understand now, sensitive. So in the marketing material, what they say is that a dividend, I want to make sure I get this right. A dividend is issued when the actual experience of the underlying block is more favorable than the assumptions made when the policy was priced. So those illustrations, the numbers that you see...
Interesting choice of words to explain that.
It's hard to. So basically, when you buy a policy, the numbers that you see are based on assumptions. Now, what is that assumption? That's a collection of returns, mortalities, lapses, loans, all in there. Based, and they assume how these variables are going to perform over a 20 or 30 or 40 or 50 year period.
I assume that they also assume their own profit margins through this whole
100%.
thing.
They have to be profitable, you know? If their assumptions are accurate or exceed what they predict, then that will be accurate. Then you will get the dividends that are illustrated. However, if their assumptions are off, meaning they predicted in my client's case that interest rates would have stayed significantly higher, then dividends could decrease, which I was experienced, or vanish altogether.
Some of the assets they bought, rates came down, the assets lost value. These assumptions then aren't met on the performance of the assets.
Maybe,
we brought this up when we were going through our process.
I'm guessing. I'm just throwing shit against the wall here.
Yeah, we actually brought this up during the process when we were buying ours. We brought the same thing up. We're like, this, because of where rates are going, this stuff's...
and another angle was like just inflation adjusted. I was like, and if I inflation adjust some of the stuff that I'm going to get out here, like really what am I getting, or what is my family getting at the end?
But were you pitched also a universal life product where you just pay for the insurance and then you can invest the difference? So participating whole life, if I'm spending, with universal life, I spend $100 a month. As long as I spend $100 a month, it's worth $100,000. But I can put an additional $100 a month into it. So I put $200 a month, $100 a month into the insurance, $100 a month into the investment.
That's called participating?
That's universal life. And that $100 a month, I could pick U.S. equities, global equities.
I think that's what we don't. We don't put anything extra, but our dividends get rolled in, and we get more insurance.
That's participating. So in universal life, you get to decide where you want your money invested.
Oh, okay.
It's like in a fund, or you can guaranteed interest, or Canadian Technology Index.
Yeah, so we just give it to them and they figure
exactly.
it out.
So instead of deciding what goes where, they say, okay, we're just taking the $200 a month. You get, and we just invested for you. The difference is that the growth is not based on the performance of the par fund. The growth is based on the accuracy of their predictions. And you don't know.
And then your block within this.
Totally, exactly. And the problem is that they don't share what those predictions are. And that's kind of, I want to be careful. I don't want to criticize the product too much because it is good to an extent to have a hands-off investment. The reality is these insurance companies wouldn't be able to continue to sell these products if they didn't issue dividends. And I go over this in my book, the issue with the vanishing premiums. They have had to pay for the mistakes of the past with regards to how these policies were pitched by advisors, not by the insurance company, but pitched by advisors. And they didn't do a good enough job in reining in the advisors who would make these products seem more than what they were, right? But at the end of the day, the vast majority of people who have these are getting dividends. I would hope that based on what's happened in the past, the assumptions now are more conservative, Thankfully, we are in a rising interest rate environment, which is good for insurance companies. So ironically, as much as I crap on sometimes the product and the concept, this may be one of the best times to buy this because of a rising rate environment. Now, you can speak to people like, Jesse, the Bitcoiners are going to like, well, 2 steps forward, it's going to be 4 steps back.
28 steps back.
Exactly. We're going to get negative interest rates. And I remember there was one of the chief actuaries of one of the major insurers who actually was the actuary for this product, basically said, if you want I mentioned this in the book, I tracked him down. If you want transparency, don't buy this product. It's a black box. This was right before the pandemic. And he said, we are all betting on interest rates rising. If they go down, we're all fucked. And when he said we're all fucked, he meant your dividends are not going to be what you think they will be.
And they went straight down.
Yeah,
but
now they're coming back up.
Yeah. So my issue with the product is just there's not enough transparency about it. But listen, sometimes you want transparency, but it's nice to have something that's hands off.
It is. And I think it's just different personality types. I think Nick and I like to know all the details, and it's why it took us 6 or 8, 9, 12 months to sign this insurance policy thing, is because we kept looking at the papers and we just couldn't.
Where's this come from?
Yeah, we couldn't understand.
You can't. It's not possible.
And when we ultimately signed, like I'll never forget the day when we ultimately signed. Nick, you said, I think, hey, we got that appointment, or like we buying these policies, and I remember saying, I guess we are. Like, do you know what's going on? Thinking we had both like we just trusted the people a lot, and we still do. We still have a great relationship.
Every time we had the meeting, they were great. We were very clear on things. But then as soon as the meeting was over, an hour later, I was like, how did that one thing work again?
Well, you don't know. You can't know because
this is making me feel better because I've never walked out of meetings and 30 minutes later going, what happened there again?
Well, I don't, at the end of the day, not enough advisors have been down this rabbit hole. And it's not like I was doing research. This came from seeing policies that haven't worked out. But this all came to a head probably maybe a year and a half ago when I started to see this be your own banker, infinite banking concept pop up on Instagram all the time. A lot of guys coming out of the U.S.
Thank God I'm not on Instagram a lot. That would make me crazy.
Yeah, it does. And probably should stop scrolling, But nonetheless, it would pop probably because I'm in insurance, right? They have data, and a lot of it out of the U.S., some of it out of Canada. But they're basically positioning the participating insurance product as a bank account. Where
that's how we've always heard it. We've had people here talking about.
So explain to me what you understand of the concept.
God, this is going to be embarrassing. No. I can try. About be your own bank.
Yeah, be your own bank. Infinite banking.
There's I don't know about. I haven't looked into
it's same idea.
It's same idea. Okay, so the be your own bank, to me, the way I was understanding this particular approach was, you can get a policy that's a little bit different than what we have, that is considered a high cash value policy, and that you can contribute to it for 1 or 2 or 3 years, but in short order, after maybe 2 or 3 years, the money that you've put into it, you can actually borrow back out of the policy and use that money to do other things with. For example, buy another income property or a rental property. And then you continue contributing to this policy, and it grows until it's worth, $83 million. Yeah. I'm joking, to whatever it's going to be worth. But there's this high cash value component that you're allowed to basically kind of be your bank, where you put money into this, but you're taking it out.
You do that right now with your real estate, though. So how's that any different?
Help me make the connection there.
Well, you buy a piece of real estate.
Yeah.
It goes up in value.
Yeah. You borrow against it.
And you borrow against it, and you use that to buy more real estate.
Yeah.
So it's an asset that you can leverage to grow and create more assets. So how is that? What does it have to do with an insurance policy?
I don't really know.
You have a non-registered
other
stock
than this is
portfolio.
I guess
the real estate isn't like a piece of insurance.
Well,
yeah, it is. How is it not?
Yeah, no, it is.
Well, it's the selling feature against like a term policy or something. That's kind of
the selling feature
right?
against a term policy is that your term policy is going to be worthless in 10 or 20 years. I have a $6 million term 20. When I am 55, it's
gone.
It's gone.
Yeah, it was cheaper, but it's gone.
Yeah, I'm paying $327 a month for it, but that's.
I guess my belief was always just I was always going to get term policies, and by the time I would need a policy like this policy that we got, I'd have enough other assets in my life that I would never need it. So I would kind of seamlessly transition from term to just not needing this type of insurance.
And you have the permanent there, which kind of stays the same. It's guaranteed to pay out of debt. You can cover taxes.
Yes.
It's liquidity to your family. I noticed that with wealth, especially when you have one person who deals with the money in the family, the other person who doesn't. And I see this a lot with my book of business because I have a lot of older clients. The husband or the wife, it's older clients. It's generally the husband passes away. There's a lot of assets there. The wife doesn't know where to start. Not a lot of money in the checking account. Do I go to the TFSA, RSP? I have a line of credit. How does a line of credit work? They want to call their accountant. They need to talk to a lawyer. They don't want to touch anything. They don't want to break anything. They have 150 grand, 200 grand come in immediately. And that's just 8 months, money in the bank. I don't have to worry. And that's really what it is. It's immediate liquidity when you need it. That's what permanent.
Okay, that's a nicer way to say it. So can you walk us through it for someone who doesn't know the be your own bank or infinite banking idea? Can you explain what that is?
Yeah.
And then explain your thinking around it.
Totally. So borrowing money, generally speaking, sucks. Now you're real estate guys, you think it's awesome, right? But most people,
we have to deal with the banks, and the banks generally suck.
Exactly. And what's the problem with borrowing the bank's money? Is that you pay the bank.
It's on their terms.
It's on their terms, and the interest leaves you. It's gone. Never to be recaptured, right? What if you could borrow from yourself? Wouldn't that be wonderful?
Yeah.
Exactly. Well, now you can.
Wouldn't that be wonderful?
Now you can. You do this through this concept called the be your own banking and infinite banking concept. You buy this policy. You capitalize it, right? Grows over time. And you borrow against it. The nice part about borrowing from your own
Adam's
bank...
saying it, I'm just laughing it out.
The nice part of borrowing from your own bank is that the interest is recaptured. You make the interest. When you borrow from their bank, they make the interest. However, when you borrow from your own bank, you make that interest. It's recaptured. It comes back to you. Now, why do people think that the interest is recaptured? It's simple, because when you see this illustration, what are those numbers based on? They're based on a dividend scale interest rate. The dividend scale interest rate is presented as a percentage. So I'm going to use pre-pandemic because there are some specific videos I saw on this. Dividend scale was 5%. Interest rate is 3%. You make that 2% spread. You're effectively borrowing money for free. You're actually making money, right? The insurance company is charging you 3%. You're making 5%. You can then take that money, deploy it in real estate, other assets, pay off credit card debt, doesn't make a difference. And you're hacking the banking system because...
But you're paying that original 3%.
Well, yeah, but you're making 5%. There's a 2% spread there. The problem is that a 5% dividend scale interest rate is not the same as a 5% return. Remember, it's not the same thing. It's actually shouldn't even be a percentage. When you're driving your car and I ask you how fast you're going, right? You don't just say 35. You say kilometers an hour, right? I know how fast you're going. And when you say someone 5%, they assume that that's a piece of something. 5% of a pie, or 100, is 5. But you're not making 5% on your money. 5% is a scale. It actually should just be scale 5 or assumption 5, because if our assumptions are off, it could be 4, 3, 2, 1. So people think that they're making the interest or they're making what the banks make because of how it's presented. You're going to get 6% and you're borrowing at 3%. Or now,
so it's an assumed 5. Like it's this.
I don't know what it is. Remember,
if things go well, we assume you'll likely, probably, maybe make 5.
But no, it's not you're not making 5. Remember, there's a number of variables, and it's how accurate the assumptions are. But you don't know what the assumptions are, and they don't tell you what the assumptions are.
Yeah, so you don't even know what the 5 is based
You just have to believe in the black box.
Yes, you just exactly. Now, here's the thing. It's easy to buy into this concept in the early years. And the reason why is because the returns can be pretty handsome. My daughter has a policy. I'm paying about $223 a month for her. So $2,400 a year. Her dividend most recently was like $800. So like it's a pretty good return, you know? And hopefully she's going to get these dividends forever. I only have to pay for 20 years. And I have comfort in knowing that it's a hands-off investment. And when she's 20 years old, it'll be paid for. And hopefully she'll get dividends for the rest of her life. Even if they stop, she'll still have a policy that's hopefully worth $500,000 that she doesn't have to pay for anymore. And if dividends continue, great. If they don't, it's still good the way it is. You know, but at the end of the day, in those early years, the returns are solid. But the problem is, these companies are making assumptions 20, 30, 40, 50, like basically for the rest of her life. Like how accurate do you think those are? Like, I don't know. Like maybe they're accurate, maybe they aren't. But these insurance companies, they don't disclose what the assumptions are, which I think is unfair.
So that's the point that kind of is irking you a little bit.
Exactly. And this goes back to the Bureau of Banking concept. You shouldn't be telling people that that they are their own bank or making the interest when they're effectively not. And it's compelling people without the means to buy something that they otherwise wouldn't buy or shouldn't buy. People don't like borrowing money, especially people who don't have a lot of money. So if you tell them they can borrow from themselves and make the interest, and they're screwing the banks because now the banks aren't making the interest. They're going to be like, sweet, now I can borrow from this and I make the interest. I'm hacking the financial system. Well, no, you are doing the exact same thing, right, as borrowing from a bank. Well, it's even actually worse because there's no transparency with regards to how these dividends are given to you. You don't know what the assumptions are. You don't know what it'll look like in 10, 20, 30, 40, 50 years. It's true. The wealthy do this stuff, but the wealthy leverage all of their assets. Like Jeff Bezos, he borrows against his Amazon stock.
Sure.
You know, you could do that. Why is it that we don't have an army of advisors going around, right, talking about the Bureau of Banking concept in the context of your house? And I use this example in the book. Condo's paid off $500,000. Your advisor says, get a line of credit, put it into, you're borrowing from CIBC. How about this? Take out a line of credit and invest the line of credit into CIBC. It's going to be a wash because the dividends are a little bit lower than what the interest is. You get to participate in the upside of the stock. Your out of cost net is low.
Be your own bank.
Why isn't that be your own bank? Why isn't that infinite banking? Are you recapturing your interest because the interest that you're paying to CIBC is returning to you in the form of dividends? Well, yeah, maybe, but I think we can agree that you can't draw a straight line between the interest you're paying to CIBC and the dividends that you receive from them when they issue a dividend. And the reason why no one pitches it as be your own bank because there's no fat commission check attached to that concept. Now that's me being a cynic, but genuinely that's what I believe, you know?
But the flip side is, and I agree, I like that positioning. So the problem I had with a lot of this stuff is I never like it when things are presented as this is the ultimate solution. There's only good, because I'm a believer that there's good and bad to everything. There's always like this other side of the coin, and often it's presented like there's no downside. So whenever something's presented to me like there's no downside, I'm like, this is bullshit. Like I hate this. Why do people have to explain it? But just to continue on that, the flip side of this is that the person ends up, even so if they buy into that concept, they still do have the insurance component of the policy afterwards. But the challenge with it is if someone's buying into that concept and like you said, without the means, and they can use those funds on a monthly basis for something else that might be more important at that stage in their life, then maybe they're not being served properly by being sold onto that concept.
That's 100% the point. You know, Dave Ramsey is, right? You may not like him. He's like against debt in all forms.
I just hear his name. I don't know him well or his.
He's a
he
personal
teaches about credit and debt. And
he's
all
a
that.
personal finance expert in the U.S. Older gentleman. He has a radio show. A lot of people
Huge
call
following,
it
right?
massive.
Yeah,
following, you know, and he's like anti-debt, right? Everything in cash. You know, no one owns. No bank owns anything of yours. A lot of the aggressive real estate guys. No, you need to use debt and leverage. But also look, older dude, look where he comes from.
Sure.
It's a different generation.
Yeah.
Everybody.
He grew up with rates that were 16, 18% or whatever they were.
And like, there was no gamification of the economy then. It was very different, you know? But he calls whole life insurance the payday lender of the middle class. And there's a reason why. It's because people are tying up their cash flow, and a lot of it, in things that serve, that won't end up serving them in the long run. And that's my issue with it. So there are insurance companies that
you're seeing it on some policies where they're not living up to what the expectations were.
Where ours are like that. Just for context, I looked at ours, I think last year, or mine.
Did you?
At least.
Oh.
Yeah, because I looked at the value of it when I was looking into all this stuff. Because I started diving into this stuff a little bit. Because I'm like, why am I not buying this whole message hook, line, and sinker? And I looked into the illustration a little bit because we've had ours now for 5 years, 6 years, something like that. And we're behind the illustration. I forget by how much, but we're behind over the last 5 years. I'm like, oh, okay, well, that's one reason.
Sorry to cut you off. I don't want to say, like, name the insurance company, but I've been down the rabbit hole with all these companies. They know now that what is being illustrated will not come to fruition.
And now I know.
Right? And so much so that they tell advisors to illustrate current -1 and current -2. Now, you say current -1 or current -2 in terms of dividend scale. That's like, oh, instead of 5, it's 3 or 2.5. Well, that's a 50% drop in dividends, right?
It's not -1.
No, it's not. Exactly. It's a big difference. And remember, even though these funds are returning 7, 8, 9, 10% per year, that's like, you're not getting that.
I don't think I knew that. Did you know that, Nick?
Nobody really knows that.
Yeah. I didn't know that you were put into a block.
I didn't know about putting into the block, but I just assumed I'm not getting. They need profit. Like, what are the fees to manage those funds? And that's not. That was never explained or outlined anywhere. I'm like, well, they've left that part out because I'm sure they're not managing the funds for free.
No, they're not. Right? Listen, the 5 largest insurance companies in Canada are holding a combined $110 billion in assets on the books in these par accounts. Like, that would put it up with any massive pension fund. And imagine sitting with your advisor and your advisor says, I have an amazing fund for you. It's great long-term. You'll be like, okay, what do you think it's going to do? And he'll say, well, I think you're going to get 6% on your money every year. You'll say, that's great. Why 6%? And he can show you the breakdown of the fund. Here's why I think it'll do
110 years of a history.
Oh, no, exactly. And he'll say, listen, like, here are the primary assets.
It's so sick of that message.
I always hear that's what I always hear. 110 years, 110 years.
Here are the assets. Here's what I believe they'll do over the next 10 or 20 years because this is where the economy is going. Let's say the fund is heavy in AI or tech or whatever it is, infrastructure, oil. Doesn't matter what it is. People can have a reasonable discussion with regards to what they believe certain companies will be worth in the long run. Small or large. But imagine he says it's going to do 5% a year. And you say, what's that based on? And he says, I can't tell you. I just can't tell you. But by the way,
I like the look in Adam's eye.
Hold on a second. You only get that 5%, right, if the fund returns a certain amount. Well, what is it?
How much is that?
I can't tell you. But I'm pretty sure it will.
110 years.
110 years. What has been around for 110 years?
Nothing.
But this has,
What have we done?
Listen, I don't want to tell you to.
No. And I think that's why.
It's a good way.
I think that's why we didn't get. Nick. I don't think I told you this. I was recently meeting with someone. I told them how much we got of this stuff, and they were actually surprised how little the amount was. And the way I explained it is, I'm like, Nick and I like to understand. We like in every investment decision, if we don't have the information advantage, we feel like we're being played.
Well, you are to an extent.
Yeah. So
already,
and that's why we like real estate, because you can argue all day long if it's good or bad, but we like that we can understand all the variables. Like there's
real.
Interest rate risk. Here's maintenance problems. There's vacancy issues. There's
no the black box.
There's no black box. Like it's all in black or white. Like we can kind of lay it all out there, and we like that. Then if we feel we can layer on our own personal experience and get an information advantage on the situation, then that asset makes a lot of sense to us. We're like, yes, let's proceed. Let's go all in.
And that applies to any real, like you're talking about real estate, but we're open to any asset.
Oh my gosh.
Really, if those types of principles
any asset. And it's part of the reason I don't go into some stocks that people think are good stocks, because I don't know what's going on in the board of directors. I don't have the information advantage. So I like
Silicon Valley Bank.
Silicon Valley Bank. I mean, I was in a tech company before it went public. I saw the inner workings of these tech companies. Well, not all of them, but some of them. It's a little wild inside there. And I'm like,
you mean to tell me the world's a little bit corrupt? And
well, I'm not saying any of that company.
No, I don't. I'm just saying, like, everyone is self-interested, of course. Like, no investment is perfect, but the goal with investing is to know as much as you possibly can.
Yeah, and I think that was the trouble, which is why we didn't go higher, is that we just couldn't understand the inner workings of this product. And you can tell the way we're explaining it even to you, it's like we don't have a complete, or at least I don't, I'll speak for myself, I don't have a firm grasp of this thing. And I ultimately
But we're not using it for that. Like, at the end of the day, for us,
we're using it for a little bit of what Adam said, a bit of quick liquid money if something was to happen.
But here's the thing. You guys should take those policies and go to the bank and get credit against them. And leverage them just like anything else.
This is a great question,
Yeah.
because I called my bank. I called the branch manager at the bank that we use, and because everyone tells me how easy it is to use these as leverage, and I talked to her there, and she's like, honestly, I have no idea how to do this. I don't know anyone how to do this. I've made some calls and I'll follow up with you. I never followed up with her, to be fair. She never followed up with me because she probably didn't get the information. So that was one of the big 5 banks. No clue. And they do volume at this branch. It's not a small branch.
So the banks that do it are Manulife Bank. They do it because they sell a lot of insurance. They understand it. Duca Financial does this as well. It's funny because I'm working with a client who met me through this book. This guy's a real estate guy. He wants to put $200,000 a year into this. And I was battling him, right? And it just got to the point, because I didn't want him to go down this road. I just wanted to make sure if you're going to put $200,000 a year into something, you're really comfortable with this. You know, that's a lot of fucking money. So on the last call, I was sitting there and I'm like, okay, so what do you want to do? And he says, I read your book. I want to do the be your own banking thing. And I said, man, it's not be your own banking. He says, Adam, shut up. Look at me. And we're on Zoom. I look at him. He's like, I'm not an idiot. I know what I want. This is what I want. I'm like, okay, need I say more? You know, we're going down the path together. I have the insurance company working with me to produce an illustration. And I want to use this to get as deep as I can, because I really want to make sure that in 20 or 30 years, it's as accurate as it could have been, and he's happy. And it's funny because they produced it and said, okay, now with this, we're going to connect you with the bank, right? The third party, Duca Financial, specifically to do a third-party loan.
I know. And
I found that ironic because the whole point of the be your own banking concept is that you're borrowing from yourself. It's that you're borrowing from the policy, not borrowing from a bank. But the irony is that, like, I'm pitching this concept. The insurance company's aware of this concept, this company. And the first thing they do is they're like, perfect, like, go to this other bank. And I'm like, well, that's kind of ironic. Like, we're going back to the banks, right? When the whole point was to get away from the banks, you know? But you mentioned something interesting about, like, the policy. The reality is that a lot of people confuse the product paying out with the product working. So God forbid if something happened to you, your wives would get the checks. Sure. And then the advisor would go back being like, this worked. And like, maybe you should buy it, or maybe you should give it to the kids. And she may not, probably will at some point. And people confuse the policy working with being paid a death benefit, right? And that's a sad reality. With what's going on now regarding the be your own banking concept.
And just to be clear on that, because you're saying the death penalty the death benefit was paid out in that circumstance.
Yeah, and there always are. Listen to the affirmative policy.
So that you could say, hey, it was working. What you're talking about is the investment returns within the policy during the life of that policy.
Totally. And it's okay to say to someone, I think it's going to do this. It's really impossible to know, but think of how many people don't know what a stock or a bond is. You know, there's something to be said about having hands-off investments, you know?
Yeah, no, and you keep bringing that up, and it's valid.
But the issue is that these products are being positioned at a way to hack the financial system and grow wealth, right? You're in real estate, grow wealth here too. This is not a way to grow wealth. This is a place to park wealth once you have it. This is a bill. This is something you need to pay out of pocket every month. It may pay you, it may not. You better be comfortable paying this potentially for the rest of your life, you know? And history has proven that it's probably not going to work out the way it was pitched. And I go through this in my book again, The Vanishing Premium Litigation. And I believe the be-your-own banking concept that we see now is basically the vanishing premium 2.0. So back in the late 70s and early 80s, par policies were sold as vanishing premium. And the idea was interest rates were high. You buy this, and you only have to put money into it for 2, 3, or 4 years. The premiums would effectively vanish.
Yeah, they'll like pay for it. They'll pay for itself, right?
Yeah, it pays for itself. Now, the dividends would support it.
The dividends would pay for the annual premium.
Exactly. After 2, 3, 4, 5 years. So a lot of people bought into that. And the illustrations made it seem that way. This coincided, and I go through the Richard Phillips article in my book. He presented this paper to the Mississippi Bar Association in 1996, where he goes through the vanishing premium litigation. And the par policies that were sold this way kind of coincided with the computer revolution. Instead of sitting down with your advisor and buying a policy just based on a premium and a death benefit, this gentleman would sit there and show you this is what it's going to look like in your 50s, 60s, 70s, and 80s. And the returns were incredible. And the idea wasn't to borrow against it, but the idea was look how much money would be there for your family. You could even draw on these premiums in retirement to supplement your income. But what was missing from the explanations were how dependent these illustrations were on interest rates staying high.
The assumptions.
Specifically, the assumption was that interest rates would stay high forever. Now, I don't know how high, but nonetheless, that was the idea. Well, interest rates started to come down.
I remember that era. That was whole Freedom 55. Do you remember when we were younger?
Where do you think Freedom 55 comes from? You know, they sold insurance policies. This was the concept. This was the pitch. Now, the insurance company said, well, the advisors positioned it this way. Like, we didn't position it this way to the advisors, you know, and they tried to push it down on the advisors. But nonetheless, and maybe some of that's true, maybe some of that isn't true. It's probably really complicated. People hear what they want to hear, especially when they have a vested interest in selling something and they can make a lot of money. But nonetheless, premiums vanish.
Real estate has the same concerns.
Yeah,
a bunch of people say real estate will never go down. You can do no wrong. The whole thing. Every industry kind of has
I say zoom out, but of course you're right, you know. But premiums would go away, and then they started to reappear. And there was a lot of litigation in the 90s and into the late 90s and early 2000s. Multi-million-dollar settlements paid out. And the reason why settlements were paid out was because there was a specific claim being made. Your premiums would vanish. My premiums didn't vanish. So like the compensation is clear. What are my premiums? $300 a month for the next 60 years? Well, you can calculate that. Nowadays, we have the same thing happening. Instead of the computer revolution of the 70s and 80s, showing people illustrations, you have the, economic gamification of the financial services industry. You have TikTok videos making things seem extremely attractive. Mm-hmm. You have a video of these illustrations, becoming your own banker, dividends for life. You have people on camera basically saying, buy this, you never have to pay off the debt, you'll get dividends for life, and it's security from your family. Now, there's no way to know whether or not that will be true. And the biggest concern I have is that we're pushing people without the means to buy into these things when they're much better off buying a term insurance policy, a disability, actual insurance to take care of risk, right? And taking that money and working with it themselves, either investing in themselves or buying a stock or buying a mutual fund. Buy anything.
So your problem really,
but this
is the black box. Like
because he's not talking about the actual.
Deeper than that. It's of course.
Well, the black box and the black box, and also any industry has good and bad people, to be fair. But in how a portion of the industry is going to position it as the ultimate solution for people that it might really not be never mind the ultimate solution, even an ideal solution.
Yeah, it's not. No, it's no solution. It's a whole life insurance policy that's going to grow. How is that? Why are you confusing that with a bank account? Why are we confusing that with wealth? Well, why? Because the Rockefellers had a policy and they borrowed against it. And the kids, well, of course, the Rockefellers probably borrowed against everything they had to build their empire. Mm-hmm. Like if you have assets, you leverage them. Why sell the asset when you can borrow against it?
And the difference between, I don't even know if I'm using the right words, whole life versus...
Well, participating whole
life versus what's
universal.
Universal.
Yeah.
That's where you still have... Are the premiums roughly the same? So let's say like for the amount of actual death benefit, the premiums are roughly the same?
They're going to be half because you're only committed to paying for the cost of the insurance.
Okay, and then what do you...
Right? So I wish I should have brought an illustration, but let's say.
So just use round numbers. So 10 grand on the participating life, 5 grand.
No, let's say 100. Let's do 100 a month UL.
Okay.
Right? 100 grand. Right? You can take 200 a month. 100 a month goes to the insurance. 100 a month goes into the investment component, and you can decide where to put that. That same participating whole life policy would be 200 a month.
Got it.
They just decide where that 100 a month goes.
Okay.
They do that for you. And you're committed to that 200 a month.
This whole thing kind of reminds me of just talking about real estate differently, because I guess you could say, okay, borrow the money to buy a property at, whatever percent interest. But real estate historically goes up at, we ran the numbers from 1969. It's
just
like
under 7.
Yeah, let's just round it to 7%. 7%. So if you're borrowing at 5% and you're paying out 5%, but the properties are appreciating at 7%, and it's appreciating at a bigger value because what you've borrowed, you're controlling an asset at a much higher value. You're way ahead here because you're paying out 5%, but you're borrowing at 7%. Like, this is just like an absolute no-brainer.
Yeah, but if you can't afford the monthly payment, because it's not, then it's a really crappy solution for you.
Yeah, if you can't afford making those payments to hold the property, this is the whole thing's going to kind of blow up on you.
Yeah.
Or looking at like a REIT. You know how you and I don't really like REITs because I just feel like, well, what am I really controlling? How many fees are in there? Like, what's really growing? Who's making what? Like, it just feels like a bit of a black box to me because they buy a bunch of real estate. Then there's a bunch of management fees in there. I don't know how it's run, how much money is leaking out in these.
With a lot of the financial products, it's hard to understand where your money is. And with this, it's even harder. But my main bone to pick is with how it's being positioned and to whom it's being positioned.
Yeah, I've never heard it that way. That's what you're basically
That's 100%. That's what
it's like. These assumptions of these returns are really just assumptions.
And that's okay.
They're just not explained like that.
And they don't need to explain it to you. You can listen. The insurance companies acknowledge that, like, they don't disclose these things. It's proprietary. We have a long history, right? But buy it. And listen, I have a client with a policy on the book from 1969. It was a $10,000 policy. She's still paying $2.50 a month, right?
Wow.
And the dividends are crazy. Like, maybe there were changes made to these funds between the late 60s and late 70s. There probably was, to coincide with this computer revolution. They ramped up sales, But that doesn't mean that someone should confuse this with recapturing your interest. And that is my biggest issue. Instead of, you have a policy, you go to Honda, you want to get a Civic. Well, instead of getting the financing through Honda, borrow it against your policy and make the payments to your policy. Why? Because you've a vested interest in the interest. Well, no, you don't. Now, if the interest rate against your policy is lower than what Honda's charging you, no brainer.
Sure.
You go where the debt's the cheapest. Yeah. But don't go where the debt is coming back to you, because it's not. It's the entire idea of recapturing your own interest, making what the banks make. It's just blatant bullshit. You're not recapturing your own interest. Now, are you kind of paying the interest through dividends, or can you borrow at a low rate and make it at a higher rate? Of course, you can do that with any form of leveraging, but you have to be careful. But the idea that you have a special vested interest in the interest that you're paying to the par fund, you just don't. And that's my biggest problem with it.
It's cool because then people have have both sides of the coin. So
and then if you want to do it, you still do it, but at least
I was going to say, like, the client that you're working with has said, hey, look, I know what you're saying. I want this anyways. But now he's going in and making that decision fully informed.
Yeah.
And I think that's the difference. And I think that's, for me, some of the piece of the process, at least, or the sales process that I've been exposed to that was missing. Because
I think that's always why we felt like we didn't feel good about it. We were like, what are we not getting?
Yeah. And now I know the flip side. And I'm like, then for me, I can then confidently make the decision one way or the other. But
why did you trust him?
That's a big of a longer story. One of the best mentors in our life was our past accountant who's passed away. He had some illness. He was able to use this policy that he had to get some medical care that extended
that he wouldn't have been able to get
that he wouldn't be able to get extended his life. So, and then he came to us and kind of shared some of this, and we thought, okay, so the way that...
And then I got it beyond that. So that's got us interested in the whole thing. And then for me, the way I looked at it, like I was explaining to you earlier, which you briefly said something that kind of made me think, like, I never looked at it that way, but I thought, so our policy is both to die, so my wife and I. So, but
Joined first or last?
joint last.
Okay, it's for the kids. Yeah.
Yeah, so it was
And it's cheaper.
It was partly if I disappear, I'm like, you know what? At least I know there's some cash value asset there that she's able to then access some funds if she needs it. So it supports her and the family, and then ultimately, it ends up being for the kids. So I'm basically like, shit, I see it now. It's just that's why I'm like, oh, so this is really for the kids. I'm like, that's basically it. Mm-hmm. And we're not high cash value, so we get more insurance for the cost. You know, so we didn't bring it forward. So our advisor said like,
I think we were allowed to buy.
But remember, insurance is for those things. You know, even with a term policy, I've had a few clients pass away of terminal illnesses, and they were able to borrow $250,000 against their term 10 insurance policy.
Really? I didn't know.
Yeah,
I didn't know that.
Terminal illness benefit. A lot of the insurance companies don't advertise it because you don't.
How would you do that? You go to Manulife or
so you have a policy with Manulife. This client of mine, she had a $1.5 million policy. She was diagnosed with cancer 4 years into the policy. She was able to borrow, as long as there was a high likelihood of death within 24 months.
Jeez.
You can borrow up to. Every insurance company is different. This case was $250,000 against her policy. She didn't have to pay the interest. They just captured the interest and they deducted it from the death benefit when she passed away 16 months later, and she got a check for $250,000.
What rate when they do that? Like, do you know? Like, I'm not the
bank
exact
rate at the time it was 3.5%.
So really, okay,
Yeah,
so
man.
that's what I was always interested in.
Adam, where do people find your book here? How do they find it?
My website, I think it's FortuneorFiction.ca.
You think, or you know?
I like how you think.
I have a lot on the go. I really haven't been pushing it that much.
FortuneorFiction.ca.
Yeah, I think it links to my other website, Niman Financial Inc. or Insurance at a Glance. As you can tell, I'm still rounding out my marketing and social media strategy, so.
No, but I think it's a great service that you put this together because to Nick's point, as long as you know what you're doing, then if you still decide to do it, it's completely fine.
Yeah, totally.
But I just feel like you're peeling back the curtain a little bit here and just sharing some information that I've found very difficult to understand.
Well, now I get it. Now I get one is giving up control. One is kind of just taking more responsibility and control of the financial side of it for yourself.
Which I've always...
I might be dumbing it down.
No, that's true. That's true.
No, which I've always understood. What I didn't quite understand was that it seemed always presented to me like such an obvious no-brainer. Like, why would you not do this? Because this is what you do. And I never quite got it. I'm like, I could just take the money myself and invest things directly myself and make these decisions. I don't understand why this was just presented almost like coming from a place of ego, like, hey, this is like, if you're considering yourself a financially literate person, you should own one of these policies. I'm actually surprised that you don't. I'm not saying our insurance guys.
I think they're actually designed for the financially illiterate, and they've been positioned and twisted for the financially illiterate.
That's what it feels like to me.
Yeah.
Exactly.
Maybe you shouldn't share this. I don't know. I looked it up online. Just the way they make commissions work. So I'm curious.
It's the annual premium. That's pretty much what I make.
So is it different based on the participating whole life versus the other one?
Listen, so I can make sometimes based on the product. I may make 55. I get a commission and then a gross up. So let's say $100 a month policy. I make 50% of that, and then a bonus of 120 to 160% on that 50%, right? Which basically works out to, if you've been around long enough and do enough business, you can make slightly more than your annual premium. So it's not that, it's only a higher commission product in the sense that when people think they are getting more than what they are getting, they're more likely to spend more money than they would otherwise.
Okay.
I have a meeting today with a couple, early 20s. They're renting in the area of my office, Keel and Finch, and they wanted whole life insurance specifically. And the reason why they wanted whole life insurance is because their parents told them to get whole life insurance. And I get this a lot from new clients, young clients. My parents want to get me whole life insurance. They wish they got more when they were younger. And what I've learned now is that it's not the reason why your parents wish they have more whole life insurance is because they have deep insecurities with regards to how much money they're leaving you, and they regret not investing more. And they look at life insurance as would have been an easy way to give them more money. Therefore, they say to their kids, I wish I did this. I want you to do it. When in reality, you should be telling your kids, actually take 30% of what you make, forget about it, and put it into aggressive things, whether it's real estate, stocks, learn about investing. Because I don't know any wealthy person who tells me, shit, I should have got an extra $1 million of whole life. No, big time developers who probably have money that will outlive their children's children. They're not thinking, thankfully, I got that 500K policy 20 or 30 years ago, right? What are they telling their kids? They're telling their kids, do more real estate or do more stocks. They're teaching them about money. And at the end of the day, I believe a lot of the positioning behind permanent insurance from parents to their children comes from financial insecurity. These people were interested in spending $100 a month on a whole life policy that would have given them each $100,000. They have a kid and they're renting. Meanwhile, I'm speaking to them today, they're probably going to spend $25, $30 a month on $500,000 each, you know? Now, in 10 years, there's potentially another sale for them, for me here. But like that's the responsible product to sell, and then take that $70 and save it. A lot of people say, well, buy term, invest a difference. And like, I guess that's true. A lot of advisors will position it that way because they want the individual to invest it with them. I personally, I don't deal with investing anymore. You can't be everything to everybody. I want to focus on this and some other tech stuff that I'm working on. But at the end of the day, the idea should be to put your money in places that it's working for you. And the worst thing you should do is put your money in something that requires a massive spend, because all that's doing is sucking resources from elsewhere. These are great products to have when you have passive income that's paying for them. So there are families that I'm working with that have real estate portfolios. They want that to transfer to their kids. There's going to be massive taxes when they dispose of that asset. They don't want the kids to have to take out a line of credit. That's complicated. So what do? They buy a big joint last to die insurance policy. It basically prepays the taxes, and now the kids have it. They're not working to pay those premiums. The assets are paying those premiums. They didn't become wealthy because of the policy. They became wealthy because of their smart investment decisions.
And I think that's the other point you're trying to make, is that some people are just putting so much money into some of these things, they can't get other assets in their name that could be working harder for them.
Can they? Many times, yes. You know, I have an advisor I was arguing about this with, and he said, well, you know, most of the guys I deal with, they pitch this concept, but they don't actually sell it too much. It's just a way to get feet in the door. And I'm like, you know what? That's a good point. That's kind of bullshit. You know, there's not a lot of products we do that to. If you misrepresent you can't say it's okay to misrepresent a product, but once they're sitting with me, now I'm going to be honest. You know, no one else does that. Nonetheless, I appreciated the honesty, but that still doesn't drive with me. And that's when I got the idea for doing this. Well, hold on a second. If you're attracting clientele by basically drinking the Kool-Aid, maybe I'll attract clientele by not drinking the Kool-Aid. And that's really what this is for me. My goal of this, and I don't want to like shit on insurance companies too much because we need them. Like, these products are important. I've been around long enough.
Insurance serves a need.
Yeah, totally needed, extremely important. If something happened to me tomorrow, my wife, my kids get $6 million. I have a few clients on disability who will never be able to work again. They're getting thousands a month till age 65. I've paid out critical illness claims. A lady who works for my dad's dental office got sick. $1.25 million in critical illness claims. Like, insurance is important, but the idea is that it's the 1 in 1,000, the 1 in a million. It's going to destroy your life if something happens and you need this protection. Let's stop confusing it with these grand investment schemes. Now, for the right person, when you have wealth, man, not only can it be an awesome thing to do, because if you've exhausted TFSA's RSPs, you have a big stock portfolio, it's paying tax every year, you're making money, you're paying tax every year, you can put money in these products, it grows tax-free, and then you can leverage it, take the money out effectively tax-free through loans. Awesome thing to do. And advisors want to be around a long time. They want to surround themselves with wealthy people to position these products, because fuck, if this guy putting $200,000 a year into this, I'm not going to make $200,000 a year because he's going to overfund it to maximize the cash value. But if I can make 100 G's on this and potentially do this more and more, that's an amazing livelihood for myself, right? Who wouldn't want to make $100,000 on every deal that they write? But at the end of the day, it's for a very small subset of the population. And I think that's the key. Focus on insurance for the risk. Don't focus on this product or buy into it because you have some special vested interest in the interest. You're not your own bank. You're not making what the bank does. That's horseshit. Put your money to work for you. There's a place for these products, but don't buy in to this idea that you're making what the banks make, because you're just not, you know?
Adam, thank you for this. If someone wants to reach you, give it the website again, Is it going to be FortuneorFiction.ca?
FortuneorFiction.ca, yeah.
And we'll verify that. We'll link it in the show notes of this episode so that if anyone wants to reach out to you. I think what you're doing is just building a lot of trust with people because you're kind of sharing pros and cons. And when I work with someone, when Nick worked with someone, we love that. We sit down with everyone on every real estate deal we've ever done. We're like, tell us the worst case scenario. Like, just tell us the worst case. And they think that we're asking that because we don't want to do a deal with them. We're like, no, like if we can stomach the worst case, then we're in.
Just the nice part about this is like the worst case isn't that bad. As long as you are, at the end of the day, you still have the insurance. Like you can see zero dividends is on the left side of that table there. Like it's just going to be $1 million or $2 million policy. It's probably not going to be that because there will be some dividends. So, and that's why it's appealing, because there are guarantees and securities.
But you're helping me build a bit of clarity on that other part, which I appreciate.
Yeah, no worries. Thank you. Well, this was awesome. I really like the office.
You're gonna have to come. You're gonna have to come back when people listen to this and come after you with all kinds of objections. Why you're wrong.
That's what kind of freaked me out here. Listen, there are guys in this industry who technically are just on. They understand the nuance of this stuff. They understand the tax.
They're math
so much better. They're like, and they're going to work with people just in another stratosphere, and I can't hold a candle to like what they know, but I know bullshit when I see it. And that's my goal with this. I want to increase my clientele. I want to sell more actual insurance. And I just want to, in the same way that people are attracting clientele to themselves by pitching this concept, I just want to kind of provide another opinion just because I don't think there's enough of it out there. That's it.
Appreciate you doing this. You didn't have to come here. We don't know each other. Thanks to Jesse Berger for making the introduction. And this has been great. Adam, thank you, man. Thanks.
You. Appreciate it.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.